Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring. Today is Saturday, January 24th, 2026. Hey, how you doing? Thanks for stopping by. I hope you had a good trading week last week, and I hope you are having a nice weekend at the moment, and I appreciate you coming to my Weekend Review podcast. I hope you are going to learn something. I hope you are going to find it valuable. So, interesting week last week. Last few days, we had a big reversal in the market up after going down, and that was good. That triggered me into some good trades. I had all in all, pretty good trading last week. I did have some winners, I did have some losers, but the most important thing always is that my winners outnumbered my losers, and that's fine. Having losing trades is just part of trading, but the real goal is to try to keep them small, which I did. So the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, all the positions that I have, and how I am managing them, and also the positions that did not go my way that I had to get out of. So I hope this is going to be helpful for you to get an idea of how I sit, wait for my trades, and then when I do take a position, how I position size, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if it moves my way, what I do when I get into trailing stop mode, and then ultimately how I exit the trade. So I hope it's going to be helpful. If it is, I would really appreciate it if you could just hit the thumbs up button. It really helps out the channel more than you know. Just lets YouTube know that there's some valuable content here. So after we take a look at the positions, we're going to talk a little bit about trader psychology. Really, everyone, it is the most important skill in trading is the psychological aspect, the ability to create a plan, and then more importantly, following the plan. Sounds easy, when the market's not open, the lights aren't blinking. Okay, I'm going to follow this plan. But as soon as the things start moving and you're making money, you're losing money, a different part of your brain kicks in. And as traders, really, it should be our goal to always precisely, like a laser, follow our plan precisely. It's in the long run, you are going to make more money if you do this. And I would imagine that's the goal of trading, is to make money, right? It makes it easier, more simple, less decisions, less stress. It's a more holistic way to trade. I've been trading for over 30 years, everyone, and every day that goes by, I am more and more convinced it's the only way. And it works really well for me. So that is why I do it. And that is why I teach it and show you guys what I do. So after the trader psychology standpoint, I did go down through my master watch list last night, and I have identified some potential trades for the upcoming week. Now, they're not where they need to be, but they're getting close. They're within striking distance. And what I'm looking for is confluences of signals being there, right there together, converging right there together. So, I'll get into it in a little bit more detail, but I like to take the highest rated trade, because many times I will have several trades to take in the same day, but I have to narrow it down to one. And I always look for the one that has the highest score, or in other words, the most confluences of signals. So, towards the end of the podcast, I will go through there, tell you what I'm looking for, tell you what the setups are, what the levels of confluences are, and if one of them gets there next week, which I always have something that gets there next week, then I will definitely consider taking the trade. All right, so before we get started, I have to run this U.S. legal disclaimer, so hang tight for about 40 seconds, and then we will get going.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with the current open trades that I have on the daily time frame. So I did take UNG, which is United Healthcare Group. I did take UNG here on the 20th of January at 388.20. And you can see it's done really well. It's headed straight up. But let's go back to why I took this trade. This trade's a little unorthodox. And if you've been watching for the channel for a while, you'll understand why. But it did have to do with this green block, and it did have to do with the 200-day moving average, which is the black line. But this green block is an order block, and order blocks are a huge part of my trading. And so let me first explain to you what an order block is. So the order block is this bar here on the 10th of December, this big, nice green bar here. So why did I take this trade? So I took the trade here because we have a swing low. And now a swing low is a low that has a higher low to the left and a higher low to the right. And then a swing high, which is has a lower high to the left and a lower high to the right. You see this? So swing low, swing high, and then I need another swing low. This low is a swing low, higher low to the left, higher low to the right, but you can see it is lower than the first swing low. So swing low, swing high, swing low. Now, when you have this in play, everybody, you need to focus on the first swing high. Remember, swing low, swing high, lower swing low. When you have that, then in the future, if you go up above that first swing high, now you've changed market structure to the upside. Swing low, swing high, lower swing low, market structure change. And so this defines the order block here, the high and the low at this bar, and I bring this into the future. Now, I took another trade on UNH here on the 22nd, if you remember, because it came back into the order block, and what happened was it rejected the halfway of this big up bar. So that's a little trick that I use whenever you have a large up bar. If 50% of that large up bar, there's going to be some inherent Fibonacci support. So here's the bar, take the low, the high, halfway of that is this line right here. Well, if it was just that line, I wouldn't take it, but we have the order block and we have the line. So I took the trade here when it rejected the halfway. My stop would have been a close underneath that. And you can see I had another really nice trade on UNG up here. And then I believe I got out here. Yeah, I got out here. But I took another trade on this on the 20th of January. And like I said, I got in at 388.20. So why did I do that? Well, first of all, we had a rejection of the order block, right? We broke market structure here, then we came back into we broke market structure over here, excuse me, then we came back, that's why I bought it the first time, but we came back all the way into the order block and then it rejected the order block, meaning it went in the order block and closed back above. Now, normally I would never take this trade, even though it rejected the high of the order block, because my stop on this trade would be either a close below this halfway line or a close below the low of the order block. So why did I take the trade? I took the trade because, yes, it rejected the high of the order block, which is important, but it also rejected this 200-day moving average, this black line. So when I took the trade here, my end of bar stop, I had to tighten it up. I had to make it closer. And my end of bar stop would just be a close below this 200-day moving average. So I took the trade because it rejected the high of the order block, even though it was extended, and it rejected the 200-day. Usually I have the 200-day moving average inside the order block, but I took this one because it was a good risk to reward ratio. And I'll point out one other reason why I took the trade. But let's just first get into the nuts and the bolts of when I took the trade. My thinking was, okay, we reject the top of the order block, we rejected the 200-day moving average. The 200-day moving average is pretty close, so it gives me a good risk to reward ratio. But I always have to decide, first of all, how many shares am I going to buy? So let me share the formula that I use. It's really quite simple, but it takes a lot of things into consideration, and that's why I use it. The first thing I need to know is how much do I have in my trading account? So let's just say I have $100,000 in my trading account. I just simply take 1% of that, right, times 0.01. I know my maximum allowed loss on this particular trade now is $1,000, 1% of my total capital. If I had 200,000, my maximum loss would be 200,000. If it was a million, it'd be 10,000. If I have $50,000, 1% would be 500, right? So it works for anything. So, but for this example, let's say 1%, or let's say I have 100,000, 1%, $1,000. Now I look over to the value of the 2 ATR. ATR means average true range. This is what is it is expected to move on any one day. I take that number and times it by 2. And this is where I'm going to put my emergency stop. So you can see right now the average, the 2 ATR is 1705. It's 2 times what it's expected to move. So it shouldn't move there. Okay, so all I do is take 1% of my total capital, 1% of $100,000, divided by 1705. So that tells me to buy 58.65 shares. So I'll just round up to 59 shares. So I know I took the trade, rejection at the top of the order block, rejection of the 200-day moving average, tells me to buy 58 shares. Boom, I buy 58 shares. Now, as soon as I buy that, I look to the 2 ATR because I need that again. I take my entry price minus 1705. Okay, so if I have basically 59 shares that move 1705, I will lose $1,000 because we did the math, right? 1,000 divided by 1705. So that is my emergency stop, exactly the value of 2 ATRs below my entry. This red line down here is the emergency stop. And if it gets down here at any moment, I sell. If it touches it, I sell. Now, the good news is that this emergency stop only happens about 5% of the time, but it happens. It happened to me twice this week. So it happens, and I'm going to show you those. Okay, but so we have to know the worst case scenario, and essentially the worst case scenario is going to be if it moves down to ATR severe entry. But again, only about 5% of the time does that happen. The other 95% of the time, if you take a loss, it will be because of your end of bar stop. And as I just mentioned, my end of bar stop on this is a close below this 200-day moving average. So I always have 2 stops. Emergency stop, which is going to, if I hit the emergency stop, I'm going to lose 1% of my account, or the end of bar stop, which is always just by default design going to be much closer to your entry point. And so therefore, if you have a loss 95% of the time, it's going to be less than 1%. Okay, so entered here 388.20 with the correct amount of shares based upon the position size. Place my emergency stop 2 ATRs below, end of bar stop, close below the 200-day moving average. Now, as soon as I enter the trade, I know where my emergency stop is. I know where my end of bar stop is. The next thing I have to do is I have to look for the value of the 1.5 ATR. The 1.5 ATR right now, the value today is 1279. So as soon as I enter, place my emergency stop 2 ATRs below. But then as soon as I enter, I take my entry price plus the value of the 1.5 ATRs and I place that above. That's my orange line. This is my trailing stop level. So if I enter the trade and then anytime during the life of the trade, it gets up, it goes up 1.5 ATRs and gets to my trailing stop level, now I'm in trailing stop mode. Being in trailing stop mode doesn't mean you do anything. It's just that you're in the mode, and that mode means now that I hit trailing stop, if in the future I have a close below a previous bar's low, I'm going to get out of half. And the effect that that has is to tighten up your stop, all your stops by half, right? Because when you enter a trade and it starts to move your way, at a certain point, you have to tighten everything up. right? Because you don't want to give it all back. And so there's many ways to do this, but I have found that going into trailing stop level and then selling half just by default moves everything up by half. It's a great way to tighten up your trade and to not give back profits. And I'll show you a lot of examples today of why it was such a good idea to have. All right. So everything I have talked about so far as emergency stop, end of bar stop, going into trailing stop level, getting out of half if you have a close below previous bar's low after getting trailing stop level, these are all defensive moves, or in other words, hey, the market moved against me some way, I have to take action. But like any good sports team, everyone, you can't have a great defense, right? The end of bar stop, trailing stop level, emergency stop, these are all really good. I have a strong defense, and it's very important, but I have to have an offense too, right? You need to play offense in sports as well. And so the way that I play offense is I take off a certain amount of my shares every day if it moves a certain amount from the previous bar's close. So I'm in UNH. Let me show you exactly how I'm going to do that. And I have to do it every day. I have to change it every day. It changes every day. But it's very simple. I take the closing price. Right now, the closing price on UNH is $356.26. And now I looked for the value of the 0.45 ATR. It's $3.84. Closing price, $356.26 plus $3.84. My first profit target for Monday is $360.10. Okay, how much do you get out if it gets there, Greg? I get out of 10% of however many shares I go into the day with. If I go into the day with 50 shares and it hits my first profit target, I simply sell 5 shares. That's it. Now, I place 3 profit targets. So I showed you the first profit target, closing price, plus the value of the 0.45 ATRs is 360.10. I take the first profit target, 360.10, add the 0.45 to it again, plus 384. My second profit target, 363.94. If it gets there, how much do I sell? The same. If I go into the day with 50 shares and I hit the first profit target, 5 shares. If I hit the second profit target, another 5 shares. Now I do it one more time. I take the second profit target, 363.94 plus 3.84. My third profit target is 367.78, and if I went into the day with 50 shares, again, another 5 shares. So I always place the same amount of shares at all 3 profit targets. In this case, 5, 5, and 5. Okay? So if the market goes down, just straight down, I'm not going to hit any profit targets. If I have a nice, decent up day, I may hit 1 profit target. If I have a really good day, 2, always happy with 2. A great day, 3. Listen, sometimes I hit a record last week on VIX. 9 profit targets I took. 9. What does that mean? That means I got rid of 90% of my position in one day. It's a new record. I think my previous record was 7. So I always place 3. If it keeps going up, I have to manually enter them. Okay, but at nighttime, I always go through, enter all the 3 profit targets. So, okay, let's kind of start over with the trade, and we'll just kind of follow it as we took the trade. So again, why did I take the trade? Rejection of the order block, even though it's extended, and a close above the 200-day moving average, which is the black line. I position size, I placed my emergency stop 2 ATRs below my end of bar stops, a close below the 200-day moving average. I entered at 388.20. I placed my trailing stop level 1.5 ATRs above. Oh, sorry, I forgot to tell you. The third reason I took this trade, very important. Really, this is what made me take the trade. I mean, the other 2, the order block and the 200, yes, of course. But this is what got me off the fence and into the trade. And I talked a little bit about this, I think, last week or the week before. Do you notice how my bars are green, blue, or red bars? All of them. Green, blue, or red. I studied one-on-one with Dr. Alexander Elder. And these bars here, the different colors, are the Elder Impulse indicator. And let me just show you. When the bars are green, what that means is the trend is up and the MACD is increasing to the upside, okay? When the trend's up, MACD is increasing to the upside, they're green. When the trend is down and momentum is decreasing at the same time, they're red. When the bars are blue, it means one's like momentum is going up, but the trend's down, or the trend's up, but momentum's going down. So the blues are kind of neutral, the reds are bearish, and the greens are bullish, okay? So notice the day that I entered the trade, green bar, right? But look to the left. Look at the prior day. It was red. I have noticed for decades and decades of trading, everybody, that when you have a red bar followed by a green bar, something has shifted very suddenly. Essentially, momentum was down, trend was down, but the very next bar switched very quickly to momentum up, trend up. When you have this rapid change from red to green, I've discovered this. I'm not going to take the trade just based upon that, but if that happens in conjunction with other legitimate entries, it really helps the winning percentage of the trade. You know, you've heard me talk about abandoned babies, and what are abandoned babies? They're a sudden shift in sentiment from very bullish to very bearish, or I'm sorry, very bearish to very bullish, if it's a bullish one, very quickly, right? There's a lot going under the hood when that happens, when you have an abandoned baby. That's why I like abandoned babies so much. But the quick change in the Elder Impulse system from red to green, it's very similar. Very similar in what's going on. It's a very quick change in a very sudden amount of time. So that is really what put me over the edge to take this trade. Okay, so rejection of the order block, intraday rejection and close above the 200, and we went red to green very quickly. Okay, so that is why I took the trade at 388.20. So as soon as I took the trade, position size, emergency stop 2 ATRs below, closing end of bar stop, close below the 200-day moving average, place my 1.5 ATR trailing stop level above, and away we go. The very next day, up right away. Perfect, wonderful. And did I hit profit targets on this? Yeah, absolutely I did. Sold into the strength. The very next day, boom, up again, more profit targets into this strength. So there's a lot of benefits to taking the partial profits, in my opinion. One, you're selling into strength. You're reducing your position size. And just every day that if you take a little profit, that has the effect of tightening up your stop just by default. Just by default, every day that you take a little off, it just tightens everything up because you're getting out of more shares. Okay, so enter, profit target, next day up again, profit target. It was up again on Friday, not enough for a profit target, but it's been a really good trade. This particular trade is currently up 5.11%. Now, right now, the RSI on this trade 63.77. So I use a rule that when I get to a 65 RSI level, now this 5 EMA, which is thin blue line, will come into play. We didn't quite get there. Well, actually, I better measure that, make sure. At the high, no, we didn't. At the high, we're 64.56. So I like to get to at least 65 RSI. And if it goes up on Monday at all, okay, I will be in the 5 EMA will come into play. And so if it goes up and gets to 65, then closes below that 5 EMA, I am done with the trade. Now, we do have earnings coming up on the 27th, so I will exit before earnings. I always exit before earnings. I don't go into earnings and gamble on, whether I have a gain or a loss or a break even, whatever it is, I'm out. I'm not going to gamble through earnings. So anyway, this has been a really nice trade. We are in trailing stop mode, right? We got to the orange line, but doesn't mean I do anything. I just need to close below a previous bar's low. And then what will I do? I'll sell half. Okay. As long as that's all that happens. But if we get up to 65, then the 5 EMA will come into play, and then I would be completely out of the trade. Alternatively, if we get up to go much higher and get to a 70 RSI and reject that, I would sell half of the shares. And then after selling half of the shares with the rejection of the 70 RSI, then if I have another close below previous bar's low, completely out of trade. I know this sounds complicated, everybody, but if you're new to this, but really it's not. And I have a perfect example to show you of exactly what I'm doing there. But so far, obviously, it's been a good trade. Rejection of the high of the order block, rejection of the 200-day moving average, the impulse bars changing from red to green very quickly, and that's what got me into the trade. And so far, it's been good, up 5.11%. All right, Shopify. This has been an interesting trade, and I think you'll see the value in going into trailing stop mode and taking partial profits while I had them. So let's go back to the beginning of the trade. Why did I take the trade? I took the trade all the way back here, November 18th at $100, at 140.47. Why? Rejection of the high of the order block. The order block came from the past. Rejection of the high of the order block. And we had a V1. Now, if you don't know anything about V1s or V2s, you can go to my YouTube channel. I have a good video there on V1s, V2s. I think in the description of this video, I placed the link, but I don't usually use V1s or V2s to get into a trade. They're not usually a primary reason to get into a trade, but they do accentuate and help the trade if you have a primary signal. And the primary signal on this was a rejection of the order block. You see, we got back into the order block, but then we closed back above it. So that's a rejection. That by itself is legit, but we also had a V1, and I'll just quickly show you what a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 has to go below the low of bar 1, which it does, and then bar 2 has to close above the close of bar 1. Well, that's what happened. So why did I take the trade? Primary signal, rejection of the high of the order block, cherry on top, the V1. So I entered here 140.47. My emergency stop, of course, is 2 ATRs below. My end of bar stop is a close below the low of the order block, okay? I placed my 1.5 ATR trailing stop level above, and away we go. The next day goes up. Great. I hit a profit target. Next day goes up. Very nice. I hit multiple profit targets, and I am now also in trailing stop mode. But then it reverses, right? Next day up, profit target. Next day up, profit target. Nothing much here. And then on this day is our first close below the previous bar's low. After reaching trailing stop level, I take off half of the remaining shares that I have, and I did that here and locked in a gain of 5.72%. And then as we keep going, on the big bars up, took profit targets here, took profit targets here, took profit targets here, took profit targets here, right? And then we just kind of moved around. So any day that it starts going up, I sell into that strength. Not a lot of profit targets here. And then here a profit target. And then we started the move down, really move down. Now, how important is it that I sold into the strength every time it had strength here? Well, in hindsight, was really important, right? Because look where it is now. I'm actually underwater on the trade now. But am I really? No. I'm profitable on the trade because I took off half here and sold into the strength when I have it. So you can see for me how important that is. Now, when we, how should I say this? Taking the trade here, selling it to strength, getting out of half, so forth. Obviously, the shares that I have are going down, 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 down. I entered a fully new position on Friday here. And I didn't mark where it was. It was right here at the close. Why do you think I did that? Anybody have any ideas? Because we rejected the 200-day moving average inside the same order block that I bought last time. Make sense? Like when the price was way up here and you look back to this order block, can you say that smart money was buying here? Well, yeah, sure. In hindsight, you can definitely say that. When you're way up here and you look back to this order block, sure, smart money was buying that. Well, look, we are back to the smart money area and we just rejected the 200-day moving average. That is one of my favorite setups, 200-day moving average living inside an order block or a smart money area. So I had fewer shares going into the trade because of the scaling out and trailing stop and all that. So I got basically into a brand new trade on Friday here at about 137.80. So going forward, this is a new trade. I'll take this old trade off and we're just going to start from here. So getting in 137.80. Okay, I position sized on Friday to a brand new position. I placed my emergency stop 2 ATRs below. Now on this, my end of bar stop is simply going to be a close below this 200. Look how close I am to this 200 anyway. If I'm wrong, I have the chance I can just be wrong, but I can be wrong small, which is great, right? Place my trailing stop level up here, 1.5. But Monday, if this closes below the 200, I'm just out. If later in the week it closes back above the 200, can I get back in? Absolutely, I can. All right. So, but the remaining shares that I have on this particular trade are slightly down, 1.76%. But like I said, all in all, this is a profitable trade because of taking partial profits going into trailing stop mode. But going forward for this trade, it will be a brand new trade because I just re-entered to a full position size here with the rejection of the 200-day moving average inside the bullish order block. My stop is close here with a close underneath the 200-day moving average. But the remaining shares technically on this trade here, loss of 1.76%. All right, let's go to Coca-Cola. All right, so we have an order block. You can see it's the green box here. Oh shoot. Let's go back and see if we can find what this order block was about. The order block started here on the 3rd. Why? Swing low, swing high, lower swing low, market structure change, defines the order block, bring the order block into the future. Again, if you're looking here, 72.66 when it was way up here, and you look back to where that order block, do you feel confident in saying, hey, smart money was buying there? And I would say certainly was. It's not that hard because it's way up here and people were buying down here. I would say that's smart money. So we're bringing the smart money area into the future. And so in the future, if it comes back down to the smart money area, that is where I want to start to buy. Well, I did buy it right here. I had a great trade on Coca-Cola here at 67.53. Here we go, 67.53 inside this order block. And so you may say, Greg, I didn't see it reject the high of the order block. I didn't see it reject the low of the order block. Why did you buy it in here? There's no moving averages like a 200. Well, this is where I combine the deep dip buy stock trading strategy along with the order block strategy. On this particular day that I bought this, the deep dip buy strategy uses the 200, 250, 300, but it also uses a rejection of the 30 RSI. So on this particular day, RSI wise, when we were at its low, we were under the 30 RSI, but yet it was strong enough and closed back over the 30 RSI. Okay, so that's a deep dip buy order block combination. So I bought this here at 67.53 on this day because it went under 30, over 30 during the day. I got in 67.53. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop, well here, let's just go to the day that I bought it. You can see it closed at 3107. Okay, during the day it went under, closed back over 3107. My end of bar stop was simply a close back below the 30. Had the very next day it closed below the 30, even if it closed at 29.99, I would have simply gotten out for a very small loss. But thankfully it did not. So I entered here 63.53. I placed my trailing stop level 1.5 ATRs above. The next day takes off like a rocket ship, big time up. Got to trailing stop mode on the very first day. I hit multiple profit targets on this day. Next day, up again, more profit targets. Next day, kind of a nothing burger. Next day, up, profit target. And then on this day here, on the 15th, was the first time it closed below a previous bar's low after reaching trailing stop level. I had to get out of half of the position. I took off my thing there for a gain of 4.14%, but I kept half my position. So the next day down, next day up, sold into that strength. Next day kind of nothing, down. And then on Friday, it was up $1. Look at the 0.45 ATRs, 0.43. So how many profit targets did I hit? I hit 2. Okay, so the remaining shares that I have on the particular trade on Coca-Cola up 7.339. Look, we are at 65 RSI. So you see the thin blue line here. This is the 5 EMA. I'm definitely at 65 or higher, right? Because it's 65.78. So Monday, if we close below this 5 EMA, I'd simply close out the entire trade. If we continue up, I will sell profit targets into the strength. If we reject the 70 RSI, I'll sell half. And then if I have a close below a previous bar's low after rejecting the 70 RSI, I will be completely out of the trade. All right, so it's really good example, combination of a deep dip buy under 30, over 30 inside the bullish order block. Oh, and I should say, cherry on top, we did reject the negative third ATR channel, which is important. 92% of prices when they get to the negative third ATR channel stop going down or go up, and that's exactly what happened here. So it was a nice confluence of rejection of the 30 RSI inside a bullish order block and a rejection of the negative third ATR channel. And yeah, up 7, remaining shares up 7.33%. Oh, I do want to add, I was telling you about going red to green, how important that is. Red, green, very quick and fast change in sentiment from MACD down, trend down to very next day, trend up, MACD up. Was it right? It was. So I think you can get the Elder Impulse system. I think Trade Navigator has it. Trade Navigator is what I use for my charting. Trading View, I also believe, has it as well. But when you see red to green, it's important, but it has to come in the context of a legitimate signal as well. So really nice trade here on Coca-Cola, up 7.33%. Okay, speaking of rapid changes in sentiment, I took TLT, which are bonds, on the 26th of December at 87.73. So we just got done talking about red to green on the bars, but I'm going to talk to you about abandoned babies, which are very similar. Abandoned baby happens when you have a gap down. You can see the abandoned baby is here in this green bar because we gapped down. So overnight sentiment was very bad. It was very poor. It was very bearish to have that kind of gap down. But look, the very next day, all of a sudden things change. It gapped up. So when you have a gap down followed by a gap up, that is an abandoned baby. Now, when that happens, I don't usually buy it right there. I look for the high of the abandoned baby and look in the future for it to come back down and test that and reject it. And that's exactly. So you see we have a gap down followed by a gap up. I didn't chase it on that day. I waited for a pullback to come back and to test that top of that baby, and that's what happened. And so I got in at 87.73. So with this particular trade, with abandoned babies, I simplify these trades quite a lot. And all I do is, after, because these are so strong in my experience, I've done so well with them in my experience, I make them very, very simple. What I do I entered here long because of the abandoned baby. I put a 2 ATR stop below me. Remember, a 2 ATR stop, if I lose, I'm going to lose 1% of my account. But to the upside, I put a 4 ATR profit target. So I have a 2-to-1 risk to reward ratio. If I am correct, I'm going to win 2%. If I'm incorrect, I'm going to lose 1%. That's asymmetrical risk to reward. But the abandoned babies are so strong that about 70% of the time or more, I hit the 4 ATR profit target. 30% of the time, I hit the 2 ATR stop. But if about 70% of the time I make twice as much as if I lose, that's a pretty good proposition. Okay. So now this trade is up, but barely. Okay. Look, so I entered here, 2 ATR stop, 4 ATR profit target. Didn't start out very well, just down, down, down. Then it started to go up nicely. I was like, okay, good. Things are starting to move. And then here, look at this day here. Do you remember last week when we had that horrible day where bonds and everything just got sold off? Look how close I got to my 2 ATR profit, 2 ATR stop loss. Almost got there. Had it gotten there, I'd have been out of the trade. I would have lost 1%. But it didn't get there. Followed my rules, and look at the recovery we've had. Thank goodness. So this particular trade is up, which I'm very grateful for. Not a lot, up 0.22%, but I was very close to losing the 1% of this account. So anyway, we have a 4 ATR profit target above. We have a 2 ATR profit, 2 ATR stop loss below. I guarantee you, I don't know when, but I guarantee you at some point, I'm either going to hit this profit target or I am going to hit this stop loss, right? I don't think many people would argue with me one way or the other. I'm going to hit one of them eventually. But in the meantime, this does pay a monthly dividend. So great. I'll just hang out here, collect that dividend until one of these two things happen. So this one up 0.22% on a bullish abandoned baby. AMD. AMD's been a monster, everybody. It has been a monster. I entered AMD here on the 12th of January at $207.77. Let's go back and take a look at why. Well, here's our order block. Swing low, swing high, lower swing low, market structure change defines this order block here. The high and the low of this bar, bringing it into the future. And so I entered here at 207.77. Why? Because for one, it rejected the high of the order block, right? You can see it came into the order block and then it closed above, but it also rejected the red line, which is the 100-day moving average. And you know how I like moving averages that live inside the order block, right? So when I entered here, 207.77, I position size. I placed my emergency stop, of course, 2 ATRs below. But by looking at this, do you have an idea of where my end of bar stop is? Take a look. Any guesses? That's right. It's a close below the 100-day moving average, the red line. You see how close I am to it anyway? Look, this thing took off like a rocket ship. Did I know? Absolutely not. How could I? But I did know that I used this red line, the 100-day moving average, as my line in the sand. So if the very next day it would have closed below there, I would have been wrong. I would have gotten out, but very likely I would have been wrong small. And if it closed below and I got out, I could always get back in if it closed back above. So I entered here 207.77. Place my trailing stop level 1.5 ATRs above. Next day, takes off like a rocket ship. Already, I'm in trailing stop mode. Next day doesn't do much. Next day up again very strongly. I hit multiple profit targets into that strength. Next day, up a bit. I don't remember hitting a profit target there. Next day, about even. Next day takes off like a rocket ship. So I sold. I hit partial profits into that strength. The next day, up a little, but not enough for a profit target. And then Friday, up biggies, right? I hit, I think it was one profit target. But now, I'm at a 75 RSI. So this trade is super easy. If it closes below 70, I'll exit half. After that, if I have another close below previous bar's low, I will get out of the remaining position. Are we above 65? Obviously, we are at 75. So therefore, any close below this 5 EMA, I will be completely out of the trade. But this has been a monster trade, really monster trade, up 19.88%. And it all started waiting for a pullback to the smart money area or the order block, rejection of the 100-day. But really think about this, everybody. My risk was I have the emergency stop, 2 ATRs below for sure, right? 1% maximum loss. But any close below that red line, I simply would have been out for potentially a very small loss. So this is what trading is about. Being patient, waiting for a confluence of signals, and having your end of bar stop very close. So if you're wrong, you can be wrong small. If you're right, you can have something like this. And that's exactly what happened. So this trade really sums up trading in a nutshell. Patience, confluence of signals, very good risk to reward where I can lose a little or potentially make a lot. In this particular case, I'm very grateful. It was a great trade, up 19.88%. VIX. This is one of the most unbelievable trades that I've had in a long time. I entered VIX here on the 15th of January at 26.29. Why? Well, order block, swing low, followed by a swing high, followed by a lower swing low, market structure change here. This defines the order block. I bring it in. Even last week, I told you, listen, we have a bullish order block in VIX. If VIX comes back into the order block, there's a good chance VIX could bounce and there's a good chance the market could go down. It's exactly what happened. So do you remember when I told you about having a big up bar and placing a level halfway the big up bar? Well, that's why I took the trade. I took the trade because the VIX came back into the order block, rejected the midpoint of this big up bar on 113 and closed above. So I got in 26.29. I placed my emergency stop 2 ATRs below. My end of bar stop simply going to be on this one for me, closed below the low of the order block, placed my 1.5 ATRs above. Next day went up a little bit, and then on this particular day up here, I hit 9 profit targets. Remember, I place 3 profit targets, but I hit 9 profit targets. So what does that mean? It means I got rid of 90% of my trade on this one day. I always place 3, but all day long I was like, man, it went through 3. Oh, now it's at 4. Now it's at 5. Because it moved 13.56% in a day. Okay. So I basically sold all of my shares, not all, 90% of my shares into this strength. Now, I kept some shares for this podcast because I didn't want to just sell everything. And look what happened the very next day. We had a close below the previous bar's low after reaching trailing stop level. So I sold half of the remaining shares there, which were not many, for a gain of 1.76%. And then I still have a little. I mean, hardly nothing, but I just kept them for the purposes of this podcast. So the remaining shares, they're up 0.9%. Okay, not that big. But I have never sold 9 profit targets in one particular day. And so I basically sold 90% of my shares into that. And was I glad that I did that? Well, clearly, because it's come all the way back down. So this was a crazy trade. But technically, the remaining shares that I have on VIX up 0.9%. All right, last but not least on the remaining open shares is Meta. I did buy Meta on the 21st of January at 612.69. I really like this trade for a variety of reasons. First reason, we rejected the order block. The previous day we closed in the order block, we closed back over the order block. Okay, that by itself is enough. But in this particular one, if you remember from last week, I was talking about this long-term trend line. Look at this swing low here. We have a higher swing low here. We connect those swing lows with the trend line. And if we come back to that trend line, we should have some support. And that's exactly what we did. So this is a combination, everyone, of one, a rejection of the high of the order block, and two, a rejection of this long-term trend line. So I entered 612.69. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this trend line. I placed my 1.5 ATR trailing stop level above. Next day took off like a freaking rocket ship, hit multiple profit targets on this day, and then hit another profit target on Friday. So the remaining shares that I have here on Meta doing quite well, up 7.04%. I am in trailing stop mode. I'm just waiting for a close below previous bar's low. If it continues higher, I'll continue to sell into the strength. We do have earnings next week on Meta on the 28th, so I will not hold through earnings. So whether, doesn't matter how much I'm up or down or break even, I will get out right before earnings. But currently, really nice trade here, gain of 7.04%. And I want to congratulate one of my students, Jake. First trade he ever made in his life. First trade ever. Great kid, smart kid, 21 years old, friends with his father for many years. And I'm teaching him everything that I know about trading. And this was his first trade. And he's up, 7% on the first trade ever. But, could have gone the other way, but it was a legit trade. So congratulations, Jake, on your first really good, nice trade on Meta, up 7.04%. Okay, so those are all of the current trades that I have. Most of them nicely positive, right? But like I told you at the beginning of the podcast, not all of my trades this week were positive, which is fine. Doesn't mean if you have a losses here or there that you're a bad trader, because you just never know, right? But the open trades I showed you, you can see all doing quite well. Because they're doing quite well, that's why I have them. But let's go to the shares, or let's go to the trades that I had to get out of last week. And why did I get out of them? Two reasons. One, they went against me, or two, they got to certain levels above where I had to exit the trade fully. So let's start off with Berkshire Hathaway, BRKB. Okay, so I took Berkshire Hathaway here on the 22nd of January. On Thursday, I entered 484.49. Why? Two reasons. We rejected the bottom of the order block. We were below it, and then we closed back in it. That's one. And two, remember on Coca-Cola, I had the under 30, over 30? Same thing. It went under 30, over 30, and rejected the bottom of the order block. So I got in 484.49. I position size correctly. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. And my end of bar stop is simply a close below the low of the order block. What happened? It closed below the low of the order block. So what did I have to do? I was wrong. I had to get out. But very often with my trades, what you'll see is I'll be in a trade for 1 day or 2 days, then I'm wrong, I'm out. The trades that do well, I'm in for days or weeks. And that's really, in my opinion, the best way to be about it. Be very patient with your winners. Be very impatient with your losers. Well, in 1 day, out 1 day is about being as impatient as possible. So do you understand why now? Right? Under 30, over 30, rejection of the bottom of the order block. Took the trade, completely legit trade. It just didn't work. Closed below. I am out. Now, when I go through the potential trades for next week, I have another level lower that I may re-enter. But this one, I did have a loss of 1.14%. Oof, this was a brutal trade, everybody. I don't show you a lot of emergency stops, but this one I had. I entered here on the 16th of January at 52.84. Why? Rejection of the bottom of the order block with a pretty good risk to reward ratio. I entered 52.84. I placed my trailing stop level 1.5 above. My end bar stop is just a close below the order block. My emergency stop is 2 ATRs below. Look what happened the very next day. As a matter of fact, I lost a little bit more than 1% because it opened below my emergency stop, which can happen. Doesn't happen very often, but it did. So as soon as it opened, it was my emergency stop. I had to get out the first thing in the morning for a loss of 1.73%. So that's the reason I use an emergency stop, everybody. They happen. Not often, but they happen. And, you know, being a human, oh, it's like, I think that could be too low. Maybe I'll just hold on, see what happens. Nope. I followed my rules, got out immediately. Am I glad that I did? Well, sure. The next day down again. Next day up, I didn't. This was kind of a legitimate entry, but I didn't take it. And then look what happened again on Friday. So am I glad that I got out here when it's all the way down here? Yeah, you betcha. For sure. But examples of why I use emergency stop, they happen. And this was a walloper. You know, what did happen? I lost 1% of my account on this particular day because it opened below. But I got out, and I'm certainly glad that I got out. So a loss of 1.73% on that particular trade. Home Depot. Home Depot was a really nice trade. I entered Home Depot here on the 6th of January. Why? Multiple reasons. First and foremost is that we had an order block from the past. We went below it, we closed back in it. That's legit entry, rejection of the order block. Okay. Red green. Remember I was telling you about red green. Red bar to green bar. When that happens, doesn't happen very often. Usually red to blue, green to blue, right? But this was red green. Red green, rejection of the bottom of the order block. V1, bar 1, bar 2 goes under bar 1's low, closes above bar 1's close. So lots of nice confluences there, right? I entered 349.23. My emergency stop, of course, 2 ATRs below. My end of bar stop, just close below the low of the order block. That's it. Trailing stop level, 1.5 ATRs above. Next day, goes up nicely. Hit a profit target. Next day, goes up again. Profit target, and I got to trailing stop level. Next day, up again. Selling into that strength, okay? And then we kind of kept going up, but not at the same rate. I really like this example here because on this day, I got out of half. Why? Because during the day, it was above the 70 RSI, but it closed right below the 70 RSI. That tells me to get out of half of my position. So I got out of half of my position there. Oh, I took these off. For a gain of 8.17%. But then the very next day, I got out of the remaining position. Why? Because we closed below a previous bar's low after rejecting the 70 RSI. So this one rejected the 70 RSI. I got out for a gain of 8.17% on half. But then after rejecting the 70 RSI, if I then have a close below a previous bar's low, I'm out of the entire trade. And that next day, I got out of the entire trade on that half for a gain of 6.89%. So again, another example of using the red-green elder impulse system in conjunction with rejection of the bottom of the order block in the V1. So really nice trade, half at 8.17 and half at 6.89% profit. Okay, Microsoft. I hit another emergency stop, right? Usually I don't hit emergency stops. Most people didn't hit emergency stops, but I hit 2 last week, almost 3 if you count TLT. All right, let's take a look here. I entered here on the 20th of January at 454.79. Why? Rejection of the high of the order block and a rejection of the 30 RSI. So I entered 454.79. I placed my emergency stop 2 ATRs below. My end of bar stop closed below the low of the order block. Next day, what happened? Microsoft apparently was going out of business. Look, we got to emergency stop. What did I do? I had to sell, right? I had to sell for a loss of 2.97%, but the way I position size, it's a loss of 1% of my account, right? And then look what happened after that. Frustrating? Yeah, of course. Of course, right? I mean, I almost hit three emergency stops on one day. Luckily, I only hit two, but I followed my rules. But I want to give a shout out to one of my students, Bruce, who actually took the trade the next day. I did not, but he did. And so he started off at 450.70 and he had a huge day on yesterday on Friday. Let's take a quick look at why. Why? Well, we had an abandoned baby. Look here. From here to here, we gap down. The very next day, we gap up. Remember what I was telling you. If you gap down, then you gap up. That's a bullish abandoned baby. It also went under 30, over 30, closed back in the order block. I just didn't take the trade. I took different trades. But he had a great trade on that. So congratulations, Bruce, on that. He got into that position and had a big day. But me, I hit my emergency stop. And so there you go. Two examples of two emergency stops in 1 week. And on that particular trade, I lost 2.97%. So not all my trades positive at all. But did I have a profitable week? I did. So very grateful for that. Okay, last trade is on the dollar, the US dollar on the weekly charts. I trade weekly charts, daily charts, monthly charts. It's all the same thing. It's just that weekly charts close on Friday. So you only have to make one decision per week. So let me take you back. I've been in this trade all the way since 7/11/2025 at 26.31. Why did I take the trade? Well, the previous bar we were in the order block in the green and we closed back above. Is that legit? Yeah, it is. It's a rejection of the high of the order block. In addition to that, the previous week we were below the 200-day moving average, yet we closed above the 200-day moving average. Is that legit? Yes, it is. That is a close under and close over the 200-day moving average. That is a deep dip buy. I had them both in the same week. Close under, close over the 200-week moving average, and a rejection of high of the order block. I got in 26.31. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. My end of bar stop, simply a close below the 200. That's it. Next week, takes off, great, profit target. Next week, comes back, nothing. Next week, multiple profit targets into that major strength, and I also got to trailing stop level. Next week went down. Next week went down again. I had to take half off half of my position because we have our first close below previous bar's low after reaching trailing stop level. What do? I took off half my shares for a gain of 0.49%. Then we moved sideways for about a month. This week here, we were way under. I was like, oh, I'm going to have to get out. But it was strong enough and rallied and closed above the 200-week moving average, keeping me in the trade. The next week takes off, sold into that strength. The next week, nothing. Next week, strength, where I hit multiple profit targets into that strength. Couple weeks, nothing. Another bar up where I sold into the strength. Couple weeks, nothing. Another bar up, sold into the strength. So, and now we've pulled back, and then we moved up here. I hit a profit target here, and then this week, not a great week. But that's why it's important, everyone. And I'm such a big fan of taking partial profits when the market gives you something. If it ever has a big thrust move up, I'm taking something of that. So the remaining shares that I have on UUP on this weekly trade up 2.27%, which is pretty good. Doesn't sound like a lot of percentage, but for a currency, it's pretty good. So that's all that I have for you, everybody, on the trades, the open trades that I went through, the closed trades that I went through, and then UUP, the weekly trade on the dollar. So before we take a look at next week's potential setups, let's spend a few minutes on trader psychology. Hopefully this will be helpful. I really like to talk about trader psychology. I'm a big fan of it. And the more you follow your process, the better you're going to do. So let's take a look at this post. Okay, this post is from Trading Proverbs on Twitter. Excuse me. You can follow them at Trading Proverb. I like this channel. They always have good posts. And let's see what they say. This is from Bill Nygren. He's from Oakmart Funds, very famous fund. Taking advantage of the values created by emotional investors is the cornerstone of the Oakmart Fund's approach to investing. We try to buy from fearful or bored investors and sell to greedy investors who want the excitement. This is saying a lot here, everybody. And this really dovetails with how I trade and how I teach trading. I want to buy from fearful traders, buying in order blocks, buying deep dip buys under 30s, over 30s. If they're there, you generally have fearful investors. Um, bullish, bullish abandoned babies, another example of buying lows or shorting highs, right? With the gap down, the gap up. It's a really good indicator to show the bottom may be in. But, you know, a lot of traders that I know, a lot of traders that I work with before I work with them, they want the excitement. They're buying the momentum. And momentum works sometimes for sure. But me personally, it just doesn't resonate with my particular psychology and trading. Over the years, I just feel like I've done much, much better by doing exactly what Bill Nygren is talking about, right? Kind of the cornerstone of my investing is buying from fearful, emotional traders, and I'm selling to them just like they are. I sell to greedy investors who want the excitement. I buy the dips and I'm selling the rallies. I do that with the 0.45 ATR intraday profit targets. I sell at overbought levels like the 70 RSI, 65 RSI level. But really, this is true. A lot of people get into trading because they want the excitement. Oh, it's going up. I read the articles. The news is all good. This is going, go, 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 go. Well, listen, when that happens, I'm selling hand over fist. I promise you, right? But when things are bad and the charts look horrible, as long as there's legitimate setup like the order blocks and the abandoned babies and the elder impulse, red to green, that kind of stuff, that's where I want to buy. I want to buy from bored investors or fearful investors, and I want to sell to them when they are greedy. Just like Warren Buffett says, buy when everybody's selling, sell when everybody's buying. Pretty simple 101. But their whole fund is based upon this. We try to buy from fearful or bored investors and sell to greedy investors who want excitement. So my particular trading process, this is what it's for. It's set up to buy from fearful or bored investors and to sell to the ones who want excitement. And it works pretty well for me. And so consider that, consider that. So thank you very much. This is a really good post. And now let's head over and talk about potential trades for next week, okay? Okay, so I have four. Oh, wait, before we get into this, I do want to point out, after we take a look at these potential trades for next week, I am going to spend a few minutes on both the S&P 500 and the Q chart, just in general, just to see if we can get kind of some idea technically of what's going on with the indexes as much. So when I'm done with these four symbols here, stay tuned, take a look at that, because I think that's pretty important to take a look at. So yes, I went through my master watch list last night. I did identify only four, not a lot for this upcoming week, but I did identify four for a potential trade for next week. Now, these are getting close to potential entries. They're not there yet. If they were, I probably would have already taken them, but they're getting close. And as we go through them, I'll explain each one. But I do want to point out that, it's certainly possible on Monday, all four of these potential candidates could be legit entries. Does that mean I would take all four? No, it does not. I only take one per day, regardless of how many qualify. I just have to look at the qualified candidates and narrow them down to the best trade. How do I do that? Well, I give each one a scoring system. If it has one signal, I give a score of 1. If it has 2 signals, I give it a score of 2. If it has 3, I give it a score of 3. Which one do you think I'm going to take? I'm going to take the one that has 3. Doesn't mean it's going to be a profitable trade, but the odds are stacked in my favor. Now, there are times where you have something that has a really high score but the risk to reward isn't good. So you have to factor that in too, and maybe you don't take that trade even though it has the highest score because the risk to reward is not very good. I also look at other things. I look at higher time frames. You know, if I'm looking at something on the daily chart, maybe I want to look to the weekly chart to see if there's some confirmation or signals on the weekly chart. If there are, that adds bonus points to the trade. Maybe it has a red to green on the elder impulse. Well, certainly it's going to get a bonus point for that, right? I look at the relative strength. You know, if the market's down, but this one's up, well, that gets an extra point too, because it is the relative strength of that market is stronger than the rest of the market. If the market's up, but I get a signal and that one's down, even though it's legit, maybe I don't take that one because its relative strength was poor. Right. So this is, you know, the devil's in the details with trading and selecting your entry. And, you know, this is how I do it. This is how I teach my students as well. I teach them exactly how to do this. And by the way, you know, I do teach a private one-on-one lesson. I teach a 20-hour course. I've taught people from all over the world. I have taught people from absolute beginners, they don't even know what a chart is, all the way up to sophisticated um, um, hedge fund managers as well, and everywhere in between. And you know, if you take my 20-hour course, I guarantee you are going to learn a lot. I will teach you step by step every strategy that I use. We do a lot of simulation trading so that I know that you know what you're doing. It's very important to me that my students, when they graduate my class, become good traders. Like, it's super important to me. That's why I got into teaching in the first place. So if you are interested, you'd like to take the 20-hour course with me, we do it 2 hours at a time. Once per week, we do it for 10 weeks. So we'll be working together for 10 weeks, once a week for 2 hours. We'll be watching the markets. We'll see how the markets change. That's really why I like to spread it over 10 weeks, because we get all within 10 weeks, we get a lot of different markets and experience, and you can share your trades with me, and, you know, we'll look for upcoming trades and so forth. So if you're interested in becoming my student, my email is in the link of the description. Just send me an email. And usually if I get an email, I just reply and say, hey, thanks for touching base. Let's do a Skype call, a Microsoft Teams call. It's just kind of a get to know you call. It's not a sales call. I promise you, it's not sales at all. I just want to learn more about you, your trading challenges, your goals. And it's a really good time for you to ask me any questions about the course, right? So if that's of interest, please reach out to me, send me an email. Love to have you as a student. If you like online courses, I have a really good online course. I had sold so many of this course all around the world. It's the Deep Dip Buy Stock Trading Strategy. It's 9.5-hour online course. Really, really great course. And it's very affordable, somewhere between $30 and $50. So if you're interested in that, the link is in the description as well. So, okay. Thanks for listening to that, and let's get on to the potential trades for next week. Okay, so Berkshire, you know, I took Berkshire here on Thursday, and I had to get out on Friday because this order block did not hold. But listen, if you have an order block that doesn't hold, either if it goes back up in the order block, I can get back in, or I look lower to, there's usually going to be another order block below, and there is another order block below. Now, there's not a moving average inside this order block, but there's something kind of key because sometimes I put in my own. Okay, so earlier I was talking about V1s and V2s, and I showed you an example of a V1, but there is such a thing called a V2, and there is a V2 right here. Let's talk about what a V2 is. A V2 incorporates 3 bars: bar 1, bar 2. Bar 2 has to go under bar 1's low, and then bar 3 has to close above bar 1's close. Did it do that? Well, sure it did. Bar 1, bar 2. 2 goes under bar 1's low, 3 closes above bar 1's low. That is a V2. When you have a V2, the halfway of the second bar, which we call the washout bar, the halfway is an important level of support. And that level of support is 476. See the second bar halfway? We bring that into the future. Now, am I going to just buy something based upon that? No. But if it has an order block, yes. And there is an order block right here. The high and low of this bar is an order block. So we are getting very close to this level. 476. We're at 478.97. So next week, if Berkshire rejects this level, so in other words, it bounces at that level or it goes under during the day and then closes back over the day, that would be a rejection of the 476 level, that key level. I would certainly consider getting in and taking another trade on Berkshire. I wasn't right on the previous one, but I'm looking lower to another key level, and this is it. This is it. Maybe it blasts through that. Okay, I don't take it. So I have two options. I could get in with a rejection of 476.60, or of course, if it rejected the bottom of the order block is at 473.15. So either rejection of 473.15, I could take that. The 473.15 level would be my end of bar stop. Or if we get to reject 476.60, I could also take that, making the 476.60 the end of our stop as well. Okay, so we'll see. This one didn't work. Last week's trade didn't work. Maybe this one will. Palantir, PLTR. This one's pretty simple. I've been waiting for this trade for weeks and weeks and weeks. We have a beautiful order block here. What's living inside the order block? 200-day moving average. That 200-day moving average is a key level that large financial institutions key off of. And I like it. I like a 200 just by itself, but I like the 200 a lot more when it's in an order block. So the order block, the 200-day moving average is $157.17. Right now we're at $169.60. So it certainly would have to come down quite a bit to get there. I don't know if it will, but if it does, I want to be ready for it. Now, the thing is that Palantir has earnings on the 2nd. So, if it comes down or rejects that, that's legit. Sure, I could take it. I would use the 200 as my stop, but ultimately I would have to get out before earnings, right? And listen, maybe it doesn't get there, but maybe after earnings it gets there. Who knows? We just don't know. But that's what I'm looking for. Not really hopeful that it's going to get there, but if it does, I want it to be ready for it with a rejection of 157.17, and then I would use that as my stop as well. RBLX, I want to thank my student Vivek up in Canada for pointing this out. I did not catch this trade, and actually it's a pretty good one, actually. It has an order block here, right? So let's find the order block. Swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change. When you change market structure to the upside, that lowest closing bar prior to market structure change is your order block. Well, we are inside the order block for sure. And Friday, it did reject the high of the order block. Could I have taken that trade? Yeah, I could have. Did I take it? No, I didn't, but I could have. But what's interesting to me and what Vivek pointed out to me, and thanks Vivek for doing that, really appreciate it, because I didn't get this marked up, but he did show this to me. Vivek showed me some really good trades. Let's take a look at this swing low here. Let's take it this lower swing low here. When you connect these swing lows out, you have what's called the megaphone trend line. So if the swing low here and the swing low here, when you connect out into time, if the price gets to the extended trend line, you're probably going to have a bounce. Well, it's exactly what happened. We went under it, closed back above it, and then we rallied hard. So we are back above that megaphone trend line. Very often, when you close back above one of these trend lines and rally, you will back test to that trend line before taking off again. Now, I don't know for sure if that's going to happen, but I like when you back test trend lines, and what I really like about this is you're back testing a trend line, and that trend line lives inside the order block. Make sense? So really what I'm looking for next week would be a rejection. Well, if we rejected the bottom of the order block by default, we would probably reject the trend line. Not 100% sure, but very, very likely. So essentially, just to make it simple, I'm looking next week for, and it depends what day, but a rejection of the bottom of the order block I would certainly take, or a rejection of the trend line, meaning it bounced and closed back above it, or it went underneath the trend line and then closed back above it. And then my stop would simply be a close back below that trend line. So giving me a very good risk to reward. I don't know that the trade's going to work, right? But I know that we are in a bullish order block. I know we broke above it. I know we broke above the trend line. And now clearly you can see it's coming down. Think about retesting that trend line. If it retests that trend line and holds, and there's a reaction to that trend line and it holds, very likely you have a move up. Okay. Earnings coming up here on the 5th. So obviously I'm going to have to take that into consideration. But, you know, like if it triggered on Monday, you know, holding to the 5th, that definitely gives me some days for a potential trade. So I really like this particular trade. I know Vivek's been watching it closely. Definitely did show some signs of life, but then gave it all back. But this could be just a normal part of the breaking above and pulling back to retest. But again, if it retests this trend line inside this bullish order block, I would be very, very interested in that. And then last but not least, XLF. All right, so the financial sector, obviously you can see it was very, very strong and has pulled back fairly significantly. And we have a nice order block here, the high and the low of this bar on the 20th. Now, you know my favorite trades are when you have deep dip buy, major moving averages, 200 black line, 250 purple line, 300 orange line. Here are 3 key levels just by themselves, but they're more important levels because this 200, 250, and 300 are living inside the order block. That's my bread and butter, everybody. Waiting for pullbacks to order blocks and rejections of major moving averages, and then using that moving average as my line in the sand or my end of bar stop. So, you know, for example, XLF, if it came down or rejected the 200, could I take trade? Sure. Absolutely, I can take the trade. My stop close below the 200. If it goes down and closes below the 200, but yet it rejects the 250 and closes above, could I take that? Of course. What would be my end of bar stop? Simply close below the 250. If it just goes down, rejects the 300, could I take it off there? Absolutely, I could. And then I use the 300 as my stop. Or, of course, last but not least, it's a rejection of the low of the order block would also be legitimate. And the low there is 5108. So I have 4 potentials on XLF. A rejection next week, a rejection of the 200, a rejection of the 250, a rejection of the 300, or a rejection of the bottom of the order block. So yeah, that's how I look at trading, everybody. I'm looking for key levels like a 200, 250, 300, under 30, over 30. Those are all key levels, but I'm looking for key levels within key levels, right? So I'm looking for these key levels within an order block, which is a key level. Key levels within key levels with a good risk to reward ratio. That's the formula. That's the winning formula. And then, of course, you got to follow your formula too, right? Back to trading psychology. So listen, everybody, I appreciate you listening to this. I hope you found it helpful. If you did, I really would appreciate if you could subscribe or hit the thumbs up button. Really would help out the channel. I always like to leave people, always like to end the podcast with, please try to go out and do something nice for somebody today. If you have the opportunity, just do it. If we all did one nice thing for another human being every day, the world would just be a better place. I'm also a big animal lover. You know, if you have the opportunity to try to go out and do one nice thing for an animal when you have the chance, that'd be great, right? They appreciate it just like we appreciate it. So that's kind of my goal every day. I try to do one nice thing for another human being. If I'm able, try to do one nice thing for an animal each day if I'm helpful. And why not? Could be worse, right? So I hope you have a good rest of your weekend, everybody. If you have any comments or questions on anything I covered in the podcast, please let me know. I'm happy to answer, and I'll try to get back to you as soon as I can. But God willing, I will see you next week. And enjoy the rest of your weekend, everybody. And again, thank you very much for listening. Appreciate your time. We'll talk to you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.